There are currently over 20,000 different cryptos. How do I go about choosing the right cryptos? If you are an investor looking to invest in cryptocurrencies, there are a few important factors to consider. Project foundation. It is important to understand the team behind the project and the purpose and goals of cryptocurrency. Make sure the project has a realistic benefit and is being developed by an experienced team. Technology. Review the technological aspects of cryptocurrency, especially security and scalability. For example, some cryptocurrencies rely on proof-of-work algorithms, while others rely on proof-of-stake algorithms. Liquidity and trading volume. It is important to choose cryptocurrencies with some liquidity and active trading volume, as this allows the cryptocurrency to be bought and sold easily. Regulation. Find out about cryptocurrency regulation in your country and wherever you plan to trade it. Diversification. Spread your risk by investing in a range of cryptocurrencies rather than putting everything in a single currency. Therefore, only invest money that you can afford to lose and monitor the market regularly. In addition, it is best to invest in cryptos where you understand the business case and can therefore better assess the opportunities and risks of the token. A gamer, for example, can better assess how and whether certain crypto business cases can work in this area. Cryptos are of the cyclical variety. Cyclical assets are financial instruments issued by companies whose value depends heavily on the general economy. This includes, for example, stocks of companies that are active in sectors such as automotive, aviation or energy. Unlike defensive assets, such as bonds, cyclical assets have higher returns during good economic times, but also higher risk. In bad economic times, however, prices can fall sharply. Investors who invest in cyclical assets typically expect a higher return than defensive assets because they are willing to take on the higher risk. However, it is important to note that the performance of cyclical assets depends on general economic developments and can therefore be unpredictable. An example of a cyclical asset is an automobile manufacturer's stock. When the economy is good and people have lots of money, they are likely to buy more cars, which increases the automaker's profits and, in turn, its stock price. However, when the economy is bad and people have less money, they will buy fewer cars, which will reduce the automaker's profits and, in turn, its stock price. Overall, cyclical assets are an important component of any portfolio as they offer an opportunity to benefit from a growing economy. However, it is important to carefully assess risk and follow a well-diversified investment strategy. Buy in the bear market and sell in the bull market. What does that mean? A cryptocurrency bear market occurs when cryptocurrency prices fall over a period of time. In a bear market, investor sentiment and expectations are negative and they expect prices to continue falling. During a bear market, there can be large-scale selling of cryptocurrencies, which can cause prices to fall further. A cryptocurrency bull market occurs when cryptocurrency prices increase over a period of time. In a bull market, investor sentiment and expectations are positive and they expect prices to continue to rise. During a bull market, buying of cryptocurrencies can occur on a large scale, which can lead to further increases in prices. It is important to note that cryptocurrencies are a highly volatile asset class and can rise or fall in value quickly. In a bull market, investors can make profits by buying cryptocurrencies when prices are low and selling them when prices are higher. Therefore, it is important to carefully assess risk and follow a well-diversified investment strategy. The purchase and sale of cryptos should be triggered on the basis of evidence, i.e., on the basis of numbers, data and facts. In other words, the whole thing should happen independently of headlines and media hype. Likewise, personal emotions must be removed. The 100-week moving average can be used as an initial buy indicator. The indicator calculates the average price of a cryptocurrency over a 100-week period and draws it as a line on the chart. A cryptocurrency price above the 100-week moving average is considered oversold, and can be interpreted as a sell signal. A cryptocurrency price that is below the 100-week moving average is considered overbought, and can be interpreted as a buy signal. It is also important to note that crypto markets are highly volatile, so it is important to weigh the risks and follow a well-diversified investment strategy. It is usually not possible to time a market, i.e. to predict the low or high. During a bear market, it is therefore worth buying the corresponding cryptos monthly or weekly using the DCA strategy. Dollar cost averaging (DCA) is an investment strategy that aims to reduce the risk of cryptocurrencies or other financial instruments by buying small amounts rather than investing a large amount at once. The idea behind this is to minimize the risk of sudden price swings by investing regularly in the market rather than buying everything at once. With the DCA strategy, investors set a fixed amount that they regularly invest in a cryptocurrency or other financial instrument. This can be done, for example, every month or every week. As a result, investors automatically buy more units when the price is lower and fewer units when the price is higher. This way they reduce the risk of putting their money in the market when the price is at its highest. DCA is particularly useful for investors who are unsure of the best time to enter the crypto market or who are afraid of missing the right time. It allows them to put their money into the market slowly and steadily, rather than investing it all at once. So the idea is to use the DCA strategy primarily in the bear market and then either invest the corresponding amounts in other asset classes or increase your own cash quota for future bear markets. The art of the right exit strategy. Gains should be realized in stages. It is best to consider when buying a token at which desired selling price the first exit point should be set. In order to set exit points, a realistic potential needs to be established for each asset. For example, Bitcoin will probably not be able to reach a factor of 50 in the coming years. However, a factor of 10, 1000%, or 20, 2000% would be possible. On the other hand, an asset which, for example, only has a low market capitalization can increase by a factor of 50, 5000%. Once the exit points have been determined, the sales split still needs to be defined. So for which factor you want to sell which amount. As an example, this could be defined for an ES sell-off as follows. Sell 10% at 1500% surge. Selling 40% at 2000% surge. Selling 40% at 2500% surge. Sell 10% at 3000% surge. Thanks for watching.